During last week, the rupee was quite stable and hovered in a range between 75.40 to 75.55 on most of the days in the week, the high and low being 75.03 and 75.61 respectively. Following the whooping rise in global stocks, the benchmark BSE Sensex registered a sharp gain of 11.85% in the last 2 weeks time period from 22nd May to 5th June 2020. But the rupee maintained a stable undertone despite a weakening dollar index, which touched a low of 96.48, lowest since 12th March 2020. With more relaxations in the lockdown measures announced by the Maharashtra government, effective 3rd June 2020, the market turned optimistic and the rupee opened a lot higher at 75.04 on last Wednesday, but the dollar demand from importers and moderate intervention from RBI prevented the rupee from rising above the 75.00 resistance level. In the coming weeks, it seems quite possible for the rupee to test the 75.00 resistance backed by the positive sentiment in the global markets arising out of huge stimulus measures announced by the developed economies. It is pertinent to analyze where the rupee is headed in the next 2 months time frame from now, after recognizing the huge dollar inflows to hit the market due to private equity, FDI, and other capital inflows. The rupee would tend to appreciate beyond the 75.00 resistance at some point of time. A successful breach of 75.00 mark can take the rupee toward the 74.50 resistance, at which level aggressive buy-side dollar intervention from the central bank can be expected for sure to achieve the twin objectives of rising the forex reserves well beyond the USD 500 million mark, besides releasing rupee funds into the market to further ease the liquidity position. The forex reserves position as on 29th May 2020 was USD 493.4 billion, which is the lifetime high, and having risen by USD 3.4 billion in 1 week period. India's fiscal deficit for financial year 2019-20 widened to 4.59% of GDP, overshooting government target of 3.8%. The revenue deficit for the fiscal was at 3.27% of GDP. All in all, India's bleak economic outlook is still intact, which cannot be ignored by the market, and we expect the economic reality to wake up at some point of time over the medium term. The stability in the exchange rate, combined with the surplus liquidity in the system, triggered an easing trend in forwards across the maturities. The interest rate differential between the reverse repo rate and the Fed funds rate is about 3.25% per annum, and we expect the forwards up to 6-month maturities to settle around the above said level over a period of time. The forward dollar premium for 1 month, 3 month, and 6 month maturities ended the week at 3.40%, 3.50%, and 3.62% per annum respectively, with the forward dollar premium, USD LIBOR, and credit spread over USD LIBOR contracting amidst the scenario of stable exchange rate. The importers availing the financing facilities under the Trade Credit Guarantee or SBLC route shall gain significantly in terms of cost savings of over 3% per annum over the rupee funding cost for the corresponding tenor.